This is the Asia Trade. I'm Sherian in Tokyo.
I'm Heidi Stradwatts in Sydney, where the market has just opened. The top stories this hour. A positive lead-in for Asia as tech drives Wall Street to fresh record highs. Treasuries are paring losses after Fed Governor Chris Waller says he's leaning towards a rate cut later this month. French Prime Minister Michel Barnier facing his moment of truth, with the far-right National Rally set to join a leftist coalition to topple his government. And Intel CEO Pat Gelsinger forced out by a board that's lost confidence in his turnaround plans and ability to compete in AI.
And we'll start you off with breaking news out of South Korea. We are getting the November consumer prices rising 1.5% year on year. This is an acceleration from the previous month, but coming in below economists' estimates. And it's also a third month that we're seeing that inflation year on year rise below that 2% central bank target. A lot to do with lower base coming from last year. So if you take a look at the month-on-month prices, they actually fell 0.3% for the month of November. A bigger fall that was expected. It's also a deceleration for the first time since June. The core CPI, excluding food and energy prices, rising 1.9% year on year. So we'll continue to watch the developments around the Korean won as well, because we had seen significant pressure already coming from that surprise rate cut from the BOK last week, given the weaker economic data out of South Korea. A very different picture when it comes to Japan. Take a look at how we're setting up for the market opens, because we have seen significantly stronger and solid numbers out of Japan, which have propelled yields for the JGBs, not to mention the Japanese yen as well. It was actually the only gainer against the US dollar overnight. We're looking at 149 level right now. Nikkei futures not doing much, and the staggered open in the ASX 200 right now in Australia also not doing much. We're following the offshore yuan, of course, with news of additional restrictions on China's access to technology. Take a look at how the US dollar is trading as well, and how futures are setting up, because the dollar had a strong day, rebounding from 3 sessions of losses. We had Treasury yields rising, although curbing back a little bit of that strength in Treasury yields, given Governor Waller's comments on a potential rate cut this month. Still, we had U.S. stocks continuing to rally. We're talking about the 54th record high this year already. JP Morgan traders now seeing that we could potentially go higher on the S&P 500 by up to 4% by the end of the year. And Heidi, of course, we have to also see seasonality and a potential Santa Claus rally, and really quite a different picture from what we're seeing unfold in Europe, especially with French assets.
What an end to the year it's proving to be when it comes to the euro area, right? And Sherry, as we continue to watch these developments, France's government is close to collapsing, with the far-right leader Marine Le Pen pledging to join a left-wing coalition to topple Prime Minister Barnier's administration. It comes after Barnier invoked a constitutional mechanism to adopt a social security bill without a vote.
This bill is now here. Now is the time to act to implement it. I believe we've now reached a moment of truth which confronts everyone with their responsibilities. It's now up to you, members of the Parliament of the nation, to decide whether our country adopts responsible financial texts, essential and useful to our fellow citizens.
For more, let's bring out Bloomberg opinion columnist John Authers. And John, as you wrote, as Americans took time off to eat turkey, France has been cooking up a black swan. Do you see this as being an existential crisis, not just for France, but the broader currency area?
It has the potential to contribute to one, yes. One of the things that we've seen today, the going back to the Eurozone crisis at the beginning of the last decade, we all got used to seeing what spreads the different countries' bonds were trading at compared to German bonds. The French bonds are now at their highest spread over Germany, meaning that people perceive the highest risk since Mario Draghi more or less ended that crisis by saying that whatever he did, it would be enough to he would do whatever it took to save the euro. So that's a very serious issue. But if you look at all the other countries that might have been affected, there hasn't really been any contagion. Spanish, Italian, even Greek, Portuguese bond yields are under control, and you can't see that there's any great crisis there. Another part of the French mechanism that means this probably isn't a major jangling crisis a la what happened in 2011, 2012, is that there is no alternative but to go on to a different prime minister. There cannot be elections until next summer. So President Macron will just have to appoint another prime minister. If they don't agree on a budget, then the current budget just rolls over for a year. That is really awful, given that France has serious fiscal issues that need to be dealt with. But it's not the kind of potential total cliff edge that we were dealing with 12, 13 years ago.
Would still that be an inevitable outcome at this point? Because what happens if the government is voted down? It's not like you can have an election until the next summer. So what can President Macron do in the meantime?
That is the problem. France would appear to be at this point more or less ungovernable because there are basically three equal blocks within Parliament that obviously don't like each other and are now at a stage of just behaving strategically to thwart the others. It's very difficult to see how you can do anything about that impasse for quite a while, and given that you have the potential of Trump 2.0 tariffs on Europe and a need to come up with some kind of a sensible response to that, that's obviously very damaging to France. It obviously doesn't help France's attempts to pull in investment. It weakens the Eurozone, reduces its credibility much further. So there are many very serious problems that this creates. It weakens the Franco-German axis, which is basically at the heart of the EU as well. But in terms of what can you do to actually break the deadlock, do something dramatic, at this point it really doesn't look like there's anything. Macron is not going to choose somebody from Marine Le Pen's National Front. That's obviously out of the question. He's not going to nominate a hard leftist. So it's going to be somebody broadly similar to Michel Barnier, who will try to do something broadly similar to what Michel Barnier tried to do. And we will just drag on and at least until the summer, which is dreadful for France.
Yeah, we'll continue to watch those French assets. Bloomberg opinion columnist John Authers there joining us from New York. And we'll be watching semiconductors as well. Intel CEO Pat Gelsinger was forced out after the board lost confidence in his plans to turn around the chip maker. Sources say he was given the option to retire or be removed. Let's bring in Bloomberg Intelligence senior tech analyst Mandeep Singh for more on this exclusive story. You can see the Intel stock right there, Mandeep, where we actually had some gains after we broke the news, but we actually ended the session lower. Does this just give you an indication that despite the CEO's forced removal, the road will not be easy for Intel?
Absolutely. I think I would say it creates more uncertainty because even though, Pat Gelsinger's strategy wasn't playing out the way investors expected, at least, he had the credentials when it comes to running a company like Intel. Now we don't even know whether it's going to be an internal candidate or an external candidate. And look, we know turnarounds are very tough when it comes to tech companies. And in this case, Pat had all the ingredients in terms of, making a turnaround successful. He laid out a strategy, was executing towards it, but clearly the market went against him on the chip side, with NVIDIA taking share, and the foundry side, clearly there are a lot of challenges. So I don't know if anyone else coming outside will have a better solution than what Pat Gelsinger had to offer.
Yeah, that's interesting. So is there a better sort of path to try and close the gap?
What you can do is more, financially, you can try and sell the foundry business because that's a negative gross margin. The core PC business, at least it's got positive cash flow. So I think from an investor perspective, the sum of the parts valuation is definitely more attractive for a company like Intel. And look, they will get government support because I think it was a bipartisan sort of recommendation in terms of CHIPS Act and then onshore manufacturing. So I don't expect that to change with the incoming Trump administration. And if anything, breaking the company, having two separate assets focused on their core businesses would likely be better for a turnaround than, the whole company that obviously Pat Gelsinger couldn't turn around.
And Mandeep, this is just an example of how quickly fortunes can turn in this sector, right? I mean, we have seen Samsung also lagging behind, the likes of SK Hynix, and now Intel, who used to take all of the business away from NVIDIA, actually being dominated by NVIDIA. Tell us a little bit about the huge fallout and changes in dynamics that's happening because of artificial intelligence computing.
Yeah, you bring up a good comparison. So, in the case of memory, it's just three players. And granted, SK Hynix is executing better, but not to the extent that NVIDIA has been dominating both Intel and AMD. And so in this case, because, the data center was the most profitable part of Intel's business, NVIDIA has really, taken share from them in a big way. And look, it is a secular growth market when it comes to overall semiconductors. But Intel focusing both on, reviving their foundry side as well as the chip design hasn't been a good strategy. I think a niche focus, either on the data center side or on the fab side, would probably be something that the next CEO is going to take, which means divesting, the foundry business or the chip design business. And I think that may be more suited for a turnaround that I think investors will like.
Bloomberg Intelligence senior tech analyst Mandeep Singh. We do have some breaking news when it comes to SpaceX at the moment, with SpaceX discussing a tender offer at roughly $350 billion. Now, that valuation would be a significant premium to a previously considered valuation of $255 billion. We reported that at Bloomberg News and other media outlets just last month. So that is a pretty significant jump to potentially boost the value of Elon Musk's rocket and satellite company to around $350 billion. This is according to people familiar with the matter. These current conversations are ongoing. The details of a potential transaction could change, but this would certainly cement SpaceX's status as the most valuable private U.S. company. So this tender or secondary offering, employees and some early shareholders can sell shares, would provide investors a way to kind of generate liquidity. And of course, potentially so much of this deepened valuation is also to account of these recent very much strengthened ties between Elon Musk and President-elect Donald Trump's administration. We've seen really that almost overshadow the progress that's been made when it comes to the reusable rocket market, as well as the coverage of its Starlink satellites. Sherry.
Right, Heidi, and also another top story that we're following. The U.S. has imposed new restrictions on China's access to vital components for chips and AI, escalating a campaign to contain Beijing's technological ambitions. Let's bring in our China correspondent, Min Lo, in Hong Kong. Min, we've seen so many different types of restrictions now on China's access to advanced tech. What are these new restrictions and how are they different?
Yeah, this has been a long time in the making, and it's essentially an expansion of the existing curbs. A few things that the government is doing. First, they're restricting the sale of high bandwidth memory chips. These are chips that handle data storage. They're essential for AI applications. This is on top of the existing curbs already in place for advanced logic chips. Those are the brains of devices. So again, this applies to companies outside the U.S. as well. Washington is using the Foreign Direct Product Rule, FDPR, to control products made outside the U.S. as long as they rely on even the tiniest bit of American technology. So the companies that will be affected include SK Hynix, Samsung, Micron. These are the three global leaders when it comes to HBM2 chips. The second thing that Washington is doing is to limit the sale of gear. So 24 chip making equipment as well as 3 software tools that will be affected, again affecting stopping U.S. companies making these products overseas as well. The intention is to ensure that U.S. companies can't bypass the restrictions by moving their production overseas, but there are exemptions for the Netherlands and Japan. So companies like ASML, Tokyo Electron, they are exempted for now, although these two countries are facing huge pressure from the U.S. to match those restrictions. And the third thing they are doing is to add another 140 companies onto an entity list. This means that other companies will now need special licenses to be able to sell these companies any American technology. And again, you know, this was slightly less severe than expected. Some companies initially thought to be considered for that entity list were omitted. So this is a small win for U.S. companies that has been lobbying against these restrictions. They claim that it will hurt American companies the most if foreign companies are not playing by the same rules.
Have we seen sort of some of these affected companies or Beijing respond so far? Because this has obviously been, you know, one further step in what has been a few years now of similar curbs.
Yes, so Beijing obviously is opposed to these rules. They have said that this is an abuse of the export control measures. It is economic coercion, and they have vowed to take all necessary measures to protect their interests. You have companies like ASML, for example, coming out to say that the new rules will not materially impact their business this year, although they said if the Dutch government does come to the same conclusion when it comes to the security assessment as the U.S. government, that could affect their export of lithography systems to China. But at the same time, for these Chinese companies, it certainly is going to be a big setback for them when it comes to, you know, reaching their chip ambitions. But of course, it is going to push China to double down on its self-sufficiency push. Washington is saying they're imposing these rules because these AI capabilities, they will be able to help China boost its military capabilities and also even suppress human rights even further. And that's why they're expanding this chip restrictions, this architecture that's really been in negotiations for a long time.
Bloomberg's China correspondent Min Min Lo there. More ahead on the Asia trade. This is Bloomberg.
At present, I lean towards supporting a cut to the policy rate at our December meeting. But that decision will depend on whether data that we receive before then surprises to the upside and alters my forecast for the path of inflation.
Federal Reserve Governor Christopher Waller there on the central bank's next move. Let's bring Hebe Chen, who's the market analyst at IG, for some analysis. And Hebe, so as we continue to kind of juggle these expectations for the Fed, obviously the payrolls number is key, but obviously what's also going to be key is how much fiscal policy we get from the Trump administration next year. Do you still think the idea of sort of American exceptionalism, dollar outperformance, US equities outperformance is a good bet at this point, particularly with the turmoil happening in Europe and in France?
Good morning, Heidi. Good morning, Sherry. Yes, I think we already started seeing the unfold of a little of the chaos there. I think you made a good point. We're definitely seeing that the U.S. equities, the U.S. dollars continue to outperform the other currencies, other equities, which I think for the first 6 months of the Trump's return will maybe getting to a point quite elevated. And the ramification for that is, let's take in US dollar, for example. The strength of the US dollar will definitely comes as the cost or the expenses of other currencies. With, for example, the Chinese yuan that has depreciated about 12% back in 2018 and 19. So that could be a new norm, and that could be quite a big source of uncertainty we definitely will see for the next year. And in terms of ramifications that we're potentially seeing this outperforming, we're putting extra pressures into the other countries, other equity markets, we're making the market even more volatile and making the capital over concentrated in a particular place. And that will also ultimately increase the risk as well.
So, Habi, as we look into next year, we're obviously sort of taking stock of some of the market, trends, one of them being Japan, and of course the other one to the downside has been the underperformance of China despite that fairly short-lived stimulus rebound, right? What do you see for next year when it comes to opportunities across Asia?
Well, I actually stay positive for the Japanese equity markets, like long-term view. And that is because for this year, it's a history-making year for the Japanese market. We have the record high first time in 35 years. We also have the worst day in history. But putting all that together, I think that gives me a confidence that the Japanese market is entering into the new page. So that's why my long-term confidence coming from. But also, I do think that quite a bit of headwinds coming up on the way for the Japanese equity as well, given that, for example, at least 1 or 2 hikes for the next 3 to 6 months. We're going to have to the Japan's political landscape still yet to be stable. And they are all the main source of headwinds we'll continue to putting on that. But long-term wise, I'm stay positive. Apart from that, I think Chinese equity, as you mentioned, that in terms of number-wise, it actually performed pretty well. Like Chinese equity, A50 up 20%, Hang Seng up 20%. For the next year, I do see limited upside potential for that, given a lot of things, uncertainties. But I also seeing the limited for the disappointments, because I do think this year the market has revised down the expectation, reshaped the expectation for Chinese economy, that could potentially putting a floor for the Chinese equities moving forward.
So the expectations for the Chinese equity markets are so low that we couldn't get lower from here. Are Trump's potential tariffs going to be an issue?
Well, I think what we have seen, so for example, taking Hang Seng example, the market has enjoyed such a big rally from the end of September. It's coming down after after the election, coming down for 2 months, but still, it's still above 20% from the beginning of the year, which I think tells me that the investors still holding the hope for the policy support could potentially putting the floor there, and that's one thing. And the second thing is, given the market is already pricing in the Chinese economy will grow about 4 to 4.5%, the Trump's returns already priced in a bit. We definitely will see more uncertainty coming up, but I think the market definitely has learned from the lessons and coming to get more strategies how to ride on the volatilities there.
Yeah, given also that we're seeing a lot of gyrations in the FX market already, right? The dollar usually doesn't do that well in the December period. What are you expecting for next year, especially when it comes to currencies like the offshore yuan on the other side and the Japanese yen on the other side?
Yes, I think I do focus or expect the US dollar strength will continue. I think given the hawkish, all the policies so far from the Trump is sort of leading to the inflationary, and also that his strong positions to protecting the industrial production, the opportunity in the US, I think will continue to putting the job data or job market at a very resilient and health level. And that will sort of prevent the Fed to cutting too aggressively into the next year. So I think that will be the fundamental wise. In terms of Japanese yen, I think we do now expecting the Bank of Japan will making a move sometime this month and potentially another one in March. And they will also putting the floor for the Japanese yen as well.
Right. Hebe Chen, we'll have to leave it here. Market analyst on IG. Good to have you with us. This is Bloomberg.
Take a look at what we're watching when it comes to some of the moves in the yen. That carry trade seems to be regaining popularity. Of course, that really rattled markets, so we're watching that very closely. Israel has launched airstrikes in Lebanon following a Hezbollah attack on one of its military posts. It is one of the most serious exchanges of fire since a ceasefire came into effect less than a week ago. Bloomberg's Michael Heath joins us now for more. So does this sort of endanger the ceasefire, they say, is still holding, but things are looking a little bit more precarious?
Yeah, I mean, what seems to have happened is, in this past few days that we've had the end of fighting, Hezbollah is supposed to be back behind the Litani River and supposed to withdraw there, and Israel's in monitoring the areas, and it's supposed to gradually withdraw too. What seems to have happened is Hezbollah militants have immediately started coming back across that river, and Israel has been engaging them as that's happened, because they're not supposed to be there under the ceasefire terms. And this is exactly what happened in 2006 and led to Hezbollah being so strong on Israel's border. So Israel's been trying to combat that. Now, Hezbollah has then fired off a couple of rockets that landed in the middle of nowhere, but as a symbolic gesture to Israel saying, don't do this. Israel has struck back particularly hard. And so what you've sort of got is Hezbollah is trying to recapture or regain the situation they had before this conflict, and Israel's trying to change the whole status now, and that's why it's hit back so particularly strongly against targets, missile launching targets, including the one where the missile was fired from, and other militants and arms caches in Lebanon as well. So I think it's probably still a little bit of tit for tat, and the agreement will hold. And as the US said, compared to the fighting that was going on before, this is really quite low scale. But they're both sort of signalling to each other at this stage, and a lot of that does go on between Israel and Hezbollah.
And when it comes to the fighting in Gaza, we've had that Truth Social post from President-elect Trump, and he's saying they'll be all held to pay if the remaining hostages are not released by January 20th. When he talks about those responsible, who is he targeting here? Yeah,
look, it's a real question in a way, because all hell to pay, I think Gaza has already paid hell kind of thing. I mean, it's basically been levelled. But the problem with the hostages is they're dispersed, is how everyone understands it, between various militant groups. There's not since Sinwar, the head of Hamas, has been killed, the ability to actually negotiate with a central figure who controls them all is quite difficult. And the other thing too is that the Gazans and Hamas are probably willing to have a ceasefire at this stage. It's actually Prime Minister Netanyahu who's been holding back on that, because his right-wing government sort of wants to put settlers in the north of Gaza. So what's interesting about what Trump's saying is that, it's a lot of hot air and bluster and bravado, but it actually might be more of a signal to Netanyahu than to Hamas. And what it does is it gives Netanyahu a bit of more strength in his cabinet to say to those right-wing members, look, this is Trump, you all like him, he's sort of on our side, but he is demanding this, and we're going to have to come to some sort of agreement here to get these hostages out, which would be good for everybody in a way, because how anyone in Islamic Jihad or whatever is going to respond to a Truth Social post, I mean, it's sort of absurd in a way, but what it means for Netanyahu could be quite significant.
President-elect Trump will be inheriting a lot of global challenges, right? I mean, all of a sudden, we're getting also fighting within Syria and the city of Aleppo falling within days. What's going on there?
Yeah, Sherry, it's a really interesting case in Syria. I mean, what seems to have happened is that those rebels have sort of taken advantage of Hezbollah being really, hit hard and degraded, and Russia being completely preoccupied with Ukraine. And Syria's army itself is sort of on starvation rations kind of thing. So those rebels who've been sort of camped out in the border area between Syria and Turkey have taken advantage of that, and they've gone into Aleppo, which is sort of the economic heart of Syria, and it's fallen, basically like a house of cards. So what we're sort of seeing is that Syrian regime that Russia and Iran have, they fought back the rebels and put President Assad back in charge, that it's much more fragile than anyone understood. And it's worrying in a way, because while President Assad has a very bad reputation for obvious reasons, the rebel groups we're talking about aren't freedom fighters here. These are perhaps even more, these are more extreme groups as well. And the idea of Syria sort of fragmenting into civil war again is another worry on all fronts. And Russia can bomb and Hezbollah can perhaps send some militants there, but neither of them are as strong. They just don't have the forces available at this stage to really buttress Assad's regime. So it's going to be really interesting what happens there, whether they can conjure up enough forces to then push these rebels back, or whether we're sort of seeing a new status quo or a new situation evolve in Syria.
Bloomberg's Michael Heath there with all of the latest on geopolitical tensions around the world, which markets will be watching very closely. We're watching oil prices sort of steadying after, of course, a lot of volatility. We are trying to really gauge also China's demand for energy, not to mention that OPEC Plus meeting. We're watching energy sectors on the equity markets as well. U.S. futures not doing much after touching a record high, and of course a lot to do with the inflation picture and where the Federal Reserve goes from here. We had Treasury yields gaining ground, but a little bit of a paring back after we heard from the Fed Governor Christopher Waller saying that he's inclined to vote for another rate cut, and he's saying that he's going to be watching data. Take a look at this chart right now, because we already had U.S. manufacturing activity shrinking in November by less than forecast, but investors will also be watching ahead to the jobs numbers. In fact, when it comes to U.S. economic data, we've seen a lot of positive surprises. They've been recovering from the lows in the middle of this year, especially remember when we got the October jobs report, and that was a big miss. So we'll be watching for non-farm payrolls on Friday as well. Not to mention that Chair Jay Powell's speech will be also one in focus at the Monetary Policy Symposium for clues on the Fed's next moves. Let's get more perspective with Chris Hodge, head U.S. economist and Natixis CIB. Chris, great to have you with us. You're actually expecting the Fed to cut in December.
Thank you for having me. Yes, indeed, we do expect a cut in December. We expect the Fed to continue with its cutting cycle. That's, of course, absent a really high upside miss to the jobs number on Friday, combined with a very hot inflation print coming up ahead as well. So we do expect the Fed to cut, but we think Powell's going to deliver a bit of a hawkish message and signal that there are going to be pauses on the horizon in 2025. Inflation has proven stickier than what the Fed had initially anticipated. The economy has proved more durable, and the considerable uncertainty and variance as to how Trump could implement his policies come January 2025 is going to prompt the Fed to take a more cautious perspective going into 2025.
And the fact is that the consumers in America have also become more cautious, right? I mean, we're coming off Black Friday, or we're coming off Cyber Monday, and we've seen that record spending, but it seems that people are becoming more price sensitive. How widespread would you say is really the gains that we've seen from a resilient U.S. economy, and how focused has those gains been in really a tiny set of the population as well?
Yeah, we're really looking at a very bifurcated consumer sector, with the top 20% of earners comprising about 60% of spending. These higher earners have really benefited from the run-up in asset prices, and that's really helped to propel spending. If we look at the lower end of the income spectrum, we do see consumers struggling a little bit more. We've seen delinquencies go up for auto loans, for credit card loans, et cetera. So while growth has stayed very strong so far, we don't think it can continue with the bottom third of consumers really starting to feel the pinch of high interest rates overall and starting to struggle a little bit. So we do think growth is going to slow down in Q4 and into 2025 as well.
We've kind of got to talk about the elephant in the room, right, which is the unknown when it comes to not just trade policy, but fiscal policy, taxes, immigration, and the rest of it. How do you expect all of this to play out when it comes to the potential impact on the labour market, on inflation outlooks?
Yeah, we just released a week and a half ago our revised outlook for 2025 and 2026, and I've made the joke that we might have to change that again as of January 20th when Trump takes office. So we don't think that he's going to follow through on his very hawkish trade policies. He's promised a universal baseline tariff of 10 to 20% across the board and 60% on China. I think that is economically unfeasible. We do think that's going to be scaled back a lot. We do think these tariffs are going to be more targeted. We think tariff rates on an average level are going to go up, but not nearly to the extent that Trump has promised. That's going to put upward pressure on inflation. As far as immigration is concerned, Trump has promised to deport 15 million people illegally in the U.S. right now. Over the past 25-year period, the highest number of deportations over a 4-year period has only been about 3. So he's going to fall well short of that. But slowing down both legal and illegal immigration is going to put upward pressure on service prices as well. The labor shortage of 2022 did prompt higher inflation overall, and that was at least partially ameliorated by immigration flows in 2023. So we think the combination of those factors is going to put upward pressure on inflation and downward pressure on growth overall.
It's quite interesting as we round out the year. We're now being confounded by a crisis in Europe, right? One that has a potential to not just present political division and fiscal, instability in France, but perhaps across the whole euro area. If you take a look at that, some of the uncertainties in Asia with, the anchor of China's growth story there with a big question mark over it, does that mean we're setting up for really a period, perhaps regardless of what President-elect Trump does, where American exceptionalism economically, currency-wise, is still going to be the one to watch next year?
It certainly seems that way at this point. And I think one of the big open questions we have is what is fiscal policy going to be like in 2026? Trump ran on extending his Tax Cuts and Jobs Act that was enacted in 2018. We think he's going to get a full extension of that. The big question is how much are corporate taxes going to go down, if at all? In his first term, he lowered them from 35% to the current 21%. That could go as low as 15%. If that does indeed happen, we think budget deficits are going to run about 7% come 2026. This is an unprecedented deficit for growth periods in the economy and when the country is not at war. So these are all issues that are going to help buoy growth a little bit. So it's really hard to see growth slowing down a whole lot when you have fiscal spending that's structurally about 6.5% and going to continue to go up in 2026.
Chris, and we continue to see U.S. dollar exceptionalism, right? And President-elect Trump warning against BRICS nations from veering away from the U.S. dollar. But how meaningful is this warning when, in fact, we have seen more efforts from developing nations to veer away towards other currencies, especially at a time when the U.S. has imposed so many different sanctions and even freezes of assets in the U.S. currency?
Yeah, there's definitely a risk of the use of the U.S. dollar as a weapon. The entire global financial system is geared around facilitating the flows of U.S. dollars. So this is not a threat that should be made in vain by Trump. It's perfectly understandable that strategic rivals of the U.S. would want to facilitate currency flows in a way where the U.S. could not use it as a weapon. So we don't know practically whether or not Trump is going to apply tariffs or sanctions to these countries that are even talking about this. And we don't think that he actually will pull the trigger on doing it. But it is a development certainly worth watching because it could be very consequential for global flows overall.
Chris Hodge, a U.S. economist at Natixis CIB, there with us. More ahead on the Asia trade. This is Bloomberg. This is the Asia trade, the latest when it comes to the corporate front. We're following a Delaware judge has once again rejected Elon Musk's record-setting Tesla pay package, even after shareholders supported reinstating it. Kathleen McCormick decided to stick with her original finding that the company's board was too much under Musk's influence. The stock options package was worth $56 billion by the time McCormick cancelled it, and more than $100 billion at Monday's closing price. The Biden administration is offering $7.5 billion to finance a battery hub in Indiana. The conditional loan for a joint venture between Samsung SDI and Stellantis is expected to fund 1 or 2 lithium-ion plants in the city of Kokomo. The funding could be cancelled by the incoming Trump administration if not finalized by Inauguration Day. US agriculture giant Cargill is cutting thousands of jobs globally after missing profit targets. An internal memo says the largest privately held US company will cut about 5% of its 164,000 staff. Cargill has seen earnings shrink on lower corn and soybean prices, while the US cattle herd was the smallest in 7 decades.
Heidi, the U.S. is imposing new restrictions on China's access to vital components for chips and AI, while also blacklisting 140 more Chinese entities. Bloomberg Intelligence Technology Senior Analyst Masahiro Wakasugi joins us now with more on this. And Masahiro, I'm so happy to have you here because we've heard so many rumors, speculation, sources telling us things. What exactly do these additional restrictions mean? What's the difference until now?
Yes, U.S. government added new restrictions. And if we look at the real purpose of the restriction is that to impair the China's capability to develop new or advanced chips for military use or AI. So basically the purpose remains almost the same. And the new things would be the 140 new entity lists, or HBM can be the another restriction area. So we see some addition, but the major purpose would be almost the same as before. So in that sense, as far as we hear from ASML's comment, they say that they do not have to change their original expectation, which means that probably the new restriction would be pretty much the same as before. But as far as we see the entity list, there should be some companies who will have some impact, for the additional restrictions.
When you talk about HBMs, for example, I think of SK Hynix and Samsung that's, of course, trying to catch up. How will they be impacted?
So probably we think that the current maybe demand is majority of demand coming from the U.S. customers. So as far as we talk to SK Hynix or maybe Samsung, we are discussing the impact. But it seems like we don't know if they are real customers who. But it seems like majority of customer will be U.S. and their production capacity will be almost sold out for this year and the next year as well. So probably the additional restriction to China may not have a so meaningful impact for the HBM customers.
Just quickly, we recently spoke to Tokyo Electron's head as well, and of course they make semiconductor equipment for export to China. Will they be affected?
Yeah, probably yes. And Tokyo Electron is also saying that overall demand in China for next year will down year over year. So maybe let me take an example of ASML. And as far as we analyze ASML's comment, the overall revenue impact for majority of equipment maker would be like 10 to 15% of overall revenue would be down due to China's weakening demand for next year. So in that sense, Tokyo Electron's impact could be ranging around 10 to 15% if I assume that the situation would be similar to ASML.
We'll be watching all of those chip companies in trading today. Masahiro Wakasugi, Bloomberg Intelligence Technology Senior Analyst, with a breakdown of how these new additional restrictions on exporting tech to China would affect these Asian companies. We have more ahead on the Asia Trade. This is Bloomberg.
We have just received a response when it comes to Tesla's reaction to a Delaware judge rejecting Elon Musk's Tesla pay package despite shareholder support. We are hearing from the Tesla account on X posting that a Delaware judge has just overruled a supermajority of shareholders who own Tesla and who voted twice to pay Elon Musk what he's worth. The court's decision is wrong. They're going to appeal. This ruling, if not overturned, means that the judges and plaintiffs' lawyers run Delaware. So Tesla, essentially, they're saying that they're they're set to appeal the Delaware court's ruling on Elon Musk's pay package there. The rejected package was worth $101.5 billion at the time that the ruling happened and could significantly impact Elon Musk's wealth. He has 30 days to decide whether to appeal, and clearly that is the direction they're headed in. Well, clearance has been given for Australia's first ever commercial space launch. Gilmour Space Technologies is expected to make its first test flight within a few weeks. It already has Australian customers signed up waiting to get satellites into orbit. Bloomberg's Paul Allen has more.
History will soon be made in this field in North Queensland. Gilmour Space's 25-metre-tall, 30-tonne rocket is cleared for launch by Australia's space agency.
It's really, really hard to come up with an orbital rocket, and I'm happy that we've gotten to the point we have, and I really hope that the first launch goes reasonably well. Not expected to go to orbit. Historically, they never have, but we're going to learn a lot.
It's been a long time coming. Gilmour Space started its rocket program in 2015 and was initially expected to launch in 2023. Getting regulatory clearance has taken longer than expected.
You can imagine when you go to a regulator and say, hey, guess what? I want to launch an orbital rocket from Australia, the kind of first reaction. So we've spent a lot of time educating a lot of different people.
Customers are already lining up. First in the launch queue is Space Machines, an Australian satellite company that offers roadside assistance in space. Once in orbit, its mini modules wait, deploying when needed to carry out repairs to other satellites. For Space Machines, having a local launch option will be a game changer.
I think it gets rid of a lot of different costs. Having a launch capability in Australia will mean we won't have to travel much, we don't have to think about spacecraft getting damaged, having capability to very quickly turn it around for subsequent launches. So I think it gives you a number of advantages of having it onshore.
The significance of pushing through all the technological and regulatory barriers to get the rocket to the launch pad also can't be understated.
Adam's done an amazing job of persevering through all of that. There's a sort of almost a colloquial thing where US produces unicorns, I think Australians produce cockroaches. We need to survive. And in the process of survival is success.
In terms of survival, while the test launch for Gilmour Space is an important milestone, harder challenges are yet to come. A regular, reliable launch schedule and ultimately turning a profit.
In the last couple of years, we've just had continual customer demands for us to launch. And so, the customer equation's there, and it's there as strong as it's ever been. So I think they understand once we get the technology right, our path to profitability is very quick.
As for liftoff, an exact date hasn't been settled, but space geeks keen to watch the show might consider a Queensland beach holiday for early 2025. Paul Allen, Bloomberg, Sydney.
We'll have much more ahead in the next hour on Australia Ahead. The market opens are next.
This is the Asia Trade. We're counting down to Asia's major market opens after another record high for the S&P 500. We heard from the Fed Governor Christopher Waller indicating that he is inclined to vote for a rate cut this month. But Heidi, this hour also European futures in focus given really all of the challenges that the French government is facing.
And it really kind of throws up an interesting call as to whether we're back to this situation almost by default of American exceptionalism, right? Be it you talk about the strengthening in the economy, the surge in markets and what happens with the US dollar, because this crisis in Europe, Sherry, could go well beyond France.
Yeah, the dollar actually rebounded after 3 sessions of losses already this week. But the Japanese yen also actually gained ground, the only one in the G10 peers that actually strengthened against the U.S. dollar overnight. We're seeing it sit at around that 149 level. Of course, the expectation of the BOJ potentially hiking rates this month with Governor Ueda's latest comments on really leaving that door open. So we had the 2-year yield also touch the highest level since 2008. We'll continue to watch the 10-year yield right now unchanged at the open. When it comes to the equity space, we are watching the Nikkei gaining 0.7% at the open. Do keep an eye on Tokyo Electron as well, given that it could be hit with additional U.S. Restrictions against access by China of these advanced technologies. So we'll be watching in South Korea, also Samsung and SK Hynix. Of course, we had already seen significant weakness in the Korean won, given the surprise rate cut by the BOK last week. We also got inflation numbers earlier today for the month of November. They accelerated from the previous month, but again, a third month that CPI year-on-year came in below the BOK's 2% inflation target. So we are seeing a very different economy in South Korea, which is really struggling with weaker domestic demand.
Sherry, take a look at how we're tracking just an hour into the start of the session here in Australia. This is a picture for the ASX. We're seeing upside about 0.7% there. This, as we see, really Aussie stocks just tracking that Wall Street session a little bit higher. Their financials most leading the gains, and we have seen this market tracking pretty close to record highs. We're also seeing miners doing quite well there as well. Looking at Australian bonds as well, as we have that gain across Australian bonds, and really following what we're seeing when it comes to treasuries with these expectations of what those payrolls numbers could be, as well as the commentary from Chris Waller there as well. And also very quickly watching oil markets as we have a resumption of some conflict between Israel and Lebanon as well. So a little bit of a question mark over how well that ceasefire is going to hold, but still that OPEC Plus meeting for crude remains in key focus as we see that pretty tight range-bound situation for crude. But take a listen to the comments we had from Chris Waller and the implications potentially for the rate path ahead for the Fed.
At present, I lean towards supporting a cut to the policy rate at our December meeting. But that decision will depend on whether data that we receive before then surprises to the upside and alters my forecast for the path of inflation.
Let's bring Audrey Goh, Head of Asset Allocation at Standard Chartered Wealth Management Group. Audrey, great to have you with us. What does this mean for the equity markets in the U.S.? Because we have all of these expectations of rate cuts to come, but given the inflationary outlook as well, could we see some pullback if those easing bets are not necessarily realized in 2025?
Well, our expectation is we still remain quite pro-risk going into 2025. If you look at the easing cycle by central bank, by the end of this year, we probably get close to 80% of global central bank on some major easing mode. And that's going to provide a fresh sort of impetus, supporting economic growth, liquidity, and of course, extending the business cycle and corporate earnings. So we continue to be quite pro-risk on the back of that with an overweight on U.S. equities going into 2025.
And you expect outperformance by stocks instead of bonds and cash?
Yes, certainly. We do expect stocks to continue to deliver outperformance versus bonds and cash, and then bonds, of course, to outperform cash as well. I think corporate earnings is really quite key. So if you look at the overall U.S. Earnings expectation, we're expecting around mid-teens, about 15% thereabouts going into next year. And together with Fed easing, that's going to provide some support to multiple as well. Obviously, the caveat here is that, if we were to see a resurgence in inflation, which is not a base case for the time being, but certainly a risk for us to monitor, given that overall, even with the last couple of months of rate cuts, for example, inflation has been on a gradual downward path, but remain quite resilient if you look at it, where core inflation is still above 2%. Thereabouts, which is clearly still some way away from Fed's targets rate.
How does the fiscal policy picture, the trade policy picture, potentially change that or endanger that outlook?
I think the sequencing of how the Trump administration will pursue their policy will be quite key to watch, given that he has made clear his intention in terms of trade tariffs on the rest of the world and China as well. At the same time, on the positive side, he's also pursuing the likes of deregulations and tax cuts. So sequencing matters, and our expectation is we are likely to see maybe tax cuts to be a bit more back-end loaded because you need more congressional approval. So in the meantime, the starting point of 60% tariff on China and 10 to 20% on the rest of the world is probably a starting point for a negotiation with likely, where our base case is we're likely to see a more phased approach now that Scott Bessent has been nominated to be the Treasury Secretary as well. So on the back of that, I think, which is why we continue to be quite a bit of a pro-risk in terms of our risk appetite going to 2025. But obviously the key overweight still remains the US.
When it comes to Asia, where do you see the opportunities there? Particularly, it seems like the Chinese recovery could really kind of be a long-haul story, particularly if there's more pressure coming from external sources like the US on the trade front.
So we are a bit more selective where the Chinese stock markets are concerned. I think here we prefer to take a barbell approach, focusing on high-quality stocks, non-financial SOEs that pays dividends. It really pays you to wait out for an eventual growth recovery, which we expect to come through, but potentially a bit more gradually since we have been seeing sort of bite-sized stimulus being released in drips by the Chinese authorities as well. And at the same time, we will pair that with maybe a sector which is a bit more high beta, for example, in the technology sector, which we continue to expect China to focus their attention on, given their need and wish for self-sufficiency, especially with regards to advanced manufacturing.
Given the challenges for China and sort of U.S. exceptionalism when it comes to market performance, economic performance, are we expecting more pressure on the Chinese yuan? And what would it mean also for other Asian currencies like the Japanese yen?
So that's clearly a key risk factor to be watching out for, because if you look at the previous episode back in 2018 and 2019, when tariffs was first imposed on China, we did see a almost 10% depreciation when it comes to the renminbi, and clearly with bond yields now ratcheting to record lows in the Chinese government bond space, that is also less of a supportive factor when it comes to yuan strength. So going to next year, I think we do see downside risk when it comes to Chinese yuan. And as and when the tariff rhetorics get ratcheted up, I think we probably see, the yuan maybe weakening at the margin as well. I think if you think about yen for that matter, I think yen is probably at the other spectrum where, the BOJ is one of the only major central bank expected to hike interest rate for the maybe potentially in the upcoming central bank meeting, as well as over the course of 2025 as well. So our expectation is if we look at the inflation or wage growth picture in Japan, for example, they are probably at a stage where it is prudent to continue normalizing policy, because among the major economies, Japan still has one of the lowest real interest rate across the board, and that's against the context of an economy which has been having inflation running above 2% for the last 1.5 years.
Audrey Goh, Head of Asset Allocation at Standard Chartered Wealth Management Group. Really great to have you with us. And Sherry, one of the stories that we're keeping an eye on today is, of course, changes at the top of Intel, right? And in quite a spectacular fashion. Clearly, there's been a great deal of disagreement and discontent over the progress that Intel has been able to make in its turnaround plan, in its ability to be able to kind of bridge that gap that is increasing with the likes of NVIDIA, right? And so to that point, we saw the CEO, Pat Gelsinger, really forced out after the board lost confidence in his turnaround plans at the iconic chip maker. It just adds to a lot more turmoil. And I suppose the question is really what comes next, and what more can a future CEO, future sort of leaders at Intel do that Pat Gelsinger didn't already do? And we know that he was firmly against the idea of divestitures to breaking up the company, but perhaps his exit now makes it a higher probability to divest some of these elements to unlock gains from some of parts valuation for Intel.
And yet the skepticism about where Intel goes from here was reflected really on the stock, right? We saw it trade higher by more than 6% at one point in the intraday session overnight, and then actually end the session lower. And right now, there's no clear picture of who could succeed in. This is a very difficult challenge for Intel. You alluded to NVIDIA, right? I mean, we're seeing this massive shakeup in the industry because of AI computing. NVIDIA used to compete with Intel. Now it's taking tens of billions of dollars away from Intel. And Intel has tried to expand into making chips for other companies. And that was really one of the key focuses of Gelsinger. But at the same time, that put it into direct competition with TSMC, with the likes of Samsung as well, right? It will also be a challenge for the U.S. administration as well, because we know that Gelsinger was one of the biggest supporters of the CHIPS Act, and the Biden administration has tried to really shore up support and investments into the semiconductor business. So what really this will do to the broader U.S. picture when it comes to advances in this key technological space is really going to be a big concern going forward.
Yeah, and as you say, as we saw those gyrations in the investor reaction, the stock price reaction, there's not a clear way forward that just by, ousting Pat Gelsinger, that there's going to be a new strategy and one that's going to be, possibly more successful. But you can kind of see some of the dilemma that we see in that stock price. But really the same set of problems for whoever takes over at the helm of Intel in terms of trying to make this competition a little bit more of a closer game. More ahead on the Asia trade. This is Bloomberg.
It's a risk-on day across markets in Asia. Of course, we're coming off from another record high on Wall Street. Take a look at these chip makers, though, because we have now news that the U.S. is imposing new restrictions on China's access to vital components for chips and AI, including HBM chips and chip-making gear. Bloomberg Intelligence doesn't really think that SK Hynix and Samsung will be affected by those curbs on the HBM, because SK Hynix could have sold out all of their HBM chips for 2025 because of strong demand from U.S. consumers. So Bloomberg Intelligence not necessarily seeing a lot of impact on those South Korean names. When it comes to the semiconductor equipment maker Tokyo Electron in Japan, Bloomberg Intelligence thinks that revenue to China in 2025 could decline significantly because of these updated export controls. Let's actually bring in China correspondent Ming Min Lo in Hong Kong to dissect what these new restrictions are. I mean, we've had so many of them. So tell us a little bit about how broad these curbs are and what companies could be affected.
Yeah, it is an expansion of the existing chip restrictions that we have seen. And what's new is that Washington is now adding 140 Chinese companies to an entity list that will require other companies to seek special license to sell any American technology to these companies on the blacklist. On top of that, they are restricting the sale of high bandwidth memory chips to China, as well as the sale of gear, including at least 2 dozen manufacturing equipment, as well as at least 3 software tools. And this applies not just to U.S. firms, but foreign companies as well, because the U.S. is activating the FDPR, the Foreign Direct Product Rule, which allows them to control foreign products that uses even just the tiniest amount of American technology. But there is a carve-out, an exemption made for Japan and the Netherlands, and that's why ASML, Tokyo Electron, they are exempted for now. But we know both Japan and the Netherlands had already been under huge pressure from the U.S. to match some of these restrictions. Who knows what could happen after Trump takes office, how those negotiations could go. But yes, an expansion of all the existing curbs there.
Have we seen much of a response from Beijing and the affected companies and how this rule sort of intends to affect them?
Yes, Beijing obviously is opposed to the new rule. They have said that this is a form of economic coercion, that it is really abusing export control measures. Washington, on its end, is justifying these rules by saying that they are trying to limit China's access to equipment and technology that could allow China to modernize its military or even suppress human rights even further and threaten U.S. national security. You have the American firms, their shares on the uptick yesterday, partly because this is seen as a small win for some of these U.S. companies that have been lobbying against unilateral restrictions from the U.S. They argue that they could be unfairly disadvantaged compared to their global peers if other foreign players are not playing by the same restrictions. That's because even though this is a ramp up in the restrictions, it is still less severe than had been expected. Some of these Chinese companies that were expected to be included in the entity list, they were omitted as well. So there's differing expectations here, but overall it's going to be a big setback for Chinese companies.
Bloomberg China correspondent Ming Min Lo there. And take a look at some of the movers in the Tokyo session right now. Kobayashi Pharma actually gaining ground more than 2.5%. We just heard that activist investor Oasis is seeking an extraordinary meeting. They want to go through proposals, including the appointment of 3 directors. Nintendo shares are also gaining more than 1%, despite the fact that we just heard that Saudi Arabia's sovereign wealth fund has further cut their stake in Nintendo to 5.26% from over 6%. Last month, they had already reduced their stake in the company. We have more ahead on the Asia trade. This is Bloomberg.
This bill is now here. Now is the time to act to implement it. I believe we've now reached a moment of truth which confronts everyone with their responsibilities. It's now up to you, members of the Parliament of the nation, to decide whether our country adopts responsible financial texts, essential and useful to our fellow citizens.
French Prime Minister Michel Barnier, who is now facing a potential no-confidence motion against his government, and Marine Le Pen's National Rally Party joining a left-wing bloc to support that no-confidence motion. So the French government very near collapse. So not surprising, we have seen French borrowing costs surging. Right now on that right side, you can see that the spread between the 10-year French and German notes are at around the highest level since 2012. Last week, we actually saw French yields at one point as high as Greece's. So really downside pressure on the stock markets. Broadly speaking, though, you zoom out and European futures right now are positive. In fact, they actually gained ground in the regular session overnight because you're seeing more problems, economic challenges for France, and you're potentially thinking, could we get rate cuts, deeper rate cuts from the ECB? And we actually heard from a governing council member of the ECB overnight who didn't necessarily rule out a bigger rate cut at this December meeting. So we're seeing more upside for those European futures, Heidi.
Sherry, in the meantime, we continue to watch these geopolitical developments, right, with Israel launching airstrikes in Lebanon following a Hezbollah attack on one of its military posts. It's the most serious exchange of fire since the ceasefire came into effect less than a week ago. Bloomberg's Michael Heath joins us now for more. So was this sort of surprising, I guess?
Well, it is in a way, Heidi, because both sides really did want to stop this conflict. But by the same token, they're sort of arranging themselves to sort of how this, a peacetime or a period of quiet will look. Hezbollah has been trying to infiltrate some of its members or its militants into the area that it's supposed to have left. That's about 30 kilometres from Israel's border. So Israel's been firing on them. Hezbollah has now responded with this firing on the poster that you mentioned in your intro, and Israel has then responded heavily, saying that it won't accept that. Now, Israel's attitude is that it's just sticking to the terms of the agreement, that those Hezbollah militants shouldn't be there. But then Hezbollah is like, well, Israel shouldn't be firing on people there, and often, would deny that they were Hezbollah militants as well. So it's a bit of jockeying. Hezbollah sort of wants to regain the position that it had prior to this round of fighting, where it was right on Israel's border, where it could threaten Israeli settlements quite easily. Israel is trying to change that situation, whereby its northern communities can feel safe because Hezbollah weapons can't reach there. So we might see some of this skirmishing going on, but it's sort of unclear at this stage whether it actually will worsen.
And we continue to watch, of course, the conflict in Gaza, and President-elect Donald Trump now inserting himself in the conversation, talking about hell to pay if the Gaza hostages are not released.
Yeah, Sherry. I mean, it's hard to see how much more Gaza as an area could take in terms of hell. I mean, it's in a really disastrous state now, catastrophic. Really, it's basically been levelled. What's interesting with what Trump is saying, though, is that the pressure or inadvertent pressure that might put on Israel, because the military establishment in Israel is actually very keen for a peace agreement with Hamas and to stop the fighting in Gaza. They think they've done as much as they can there, and it is time to try and bring those hostages back. Now, it's believed that perhaps up to half of the 100 hostages who've been held are still alive. There was a video released recently of one of them, and Trump, rightfully is trying to amp up the pressure, but he's probably misdirecting a bit because these hostages are sort of held by disparate groups within Gaza. And the main obstacle really to getting a deal done is Prime Minister Netanyahu, because he fears losing his right-wing coalition members that keep him in government if he does do a deal, because they're quite keen to reimpose Israeli settlements in parts of Gaza, potentially at least anyway, and they don't want the conflict there to stop. So perhaps having Trump's backing there will actually strengthen Netanyahu's hand to say, look, we've got to do a deal here and let's get these hostages out as well. So it'll be interesting to see how that unfolds. I'm not sure if it's going to impact the militants in Gaza in any way, shape or form.
We're also seeing a rekindling of fighting in Syria. It's an interesting time because we see Russia and Iran in some ways fairly stretched.
Yeah. I mean, it's sort of whack-a-mole in the Middle East at the moment in terms of crises emerging. But what's been clear is, I mean, using Hezbollah fighters and Russian air power, they managed to drive back these the insurgents in Syria, and there are various factions there fighting the government, and they had been doing quite well until Russia and Iran sort of teamed up and pushed them back. But now we've had renewed attacks from the insurgents. These guys were basically these groups were based on the border near the border with Turkey in Syria's north, and they've managed to take over a really important city there, because what's become clear is that the Syrian army is really in quite poor shape, and they just retreated barely without a fight. And as you say, with Russia tied down in Ukraine, Hezbollah has been degraded quite heavily by Israel. Iran is also on the back foot. It's sort of lost its air defences. It has to be careful with Israel as well. Just how much support the Syrian government can get to actually push back these rebels is going to be really interesting to watch, because it seems like they might not get much support at all.
Bloomberg's Michael Heath there with the latest on all of those geopolitical tensions. And these are some of the other political stories that we're following also around the world. China's Politburo has skipped releasing a readout for its regular November meeting, leaving investors looking for signs of stimulus to wait for two key gatherings later this month. The 24-member body led by President Xi Jinping appeared to skip November's meeting for the first time since May 2023. Investors now awaiting December's Politburo Assembly and the Central Economic Board Conference as well. Philippine civil groups have filed an impeachment complaint against Vice President Sara Duterte. That's even after President Ferdinand Marcos Jr. earlier warned that any impeachment effort would be a distraction that could slow reforms. The complaint, endorsed by Progressive Political Alliance Akbayan, cites Duterte's alleged unlawful acts, including corruption, bribery, and other high crimes.
Sherry, take a look at what we're watching when it comes to commodities, and pretty tight range when it comes to energy, crude trading, I should say, ahead of that OPEC plus supply meeting. Volatility has really dropped, with prices just very much steadying there, as we do expect OPEC plus to delay the restoration of production due to worries about a glut next year. That should keep prices staying in that narrow range that we've seen. We've seen a pretty wild week for zinc. Iron ore is holding stable at the moment there, though, with a little bit of downside for copper. This is Bloomberg.
Bank of America's Wendy Stewart says the lender is seeing optimism and pent-up demand from smaller U.S. firms looking to grow their businesses. The bank's president of global commercial banking also told us how they're helping foreign companies manage risks when moving into the U.S. market.
For companies that are outside of the U.S. and might look at exposure into the U.S., there is the ability to manage that interest rate exposure globally, and they can certainly take advantage of borrowing in different currencies depending on what their needs are.
Do you get the sense, Wendy, going forward, that there has been certainty for some of these smaller companies in different regions to expand, to hire, to make some of the decisions that we heard were stymied by some of the political uncertainty prior to the election?
Absolutely. I mean, when we look at our clients, I would say the sentiment's interesting right now. There is a lot of optimism, and I think there is some pent-up demand. You know, clients, I think, have been a bit surprised that the economic environment has been more stable than they were expecting. That combined with interest rates coming down and that demand is creating opportunity. You know, and we continue to work with our clients not only as they focus on the geopolitical tensions, what that means for them internationally, but also here domestically. And, you know, we are continuing to do a lot with clients with the core banking needs that they have, whether it's loans, deposits, really helping them to manage their the cash management process. And, you know, we have a new client that we've started working with that's based in the Midwestern United States. And this company is also doing business in Canada. They have exposure in two geographies outside of North America in two different regions. And when they looked at that entire cash management ecosystem that they had to manage, they were doing it on a very manual basis. They didn't have a lot of visibility. They had FX risk that they wanted to take off the table. And so we helped them with our CashPro system to put a solution in place. It is the platform into the bank that is both online and mobile, and it's enabled them to really manage all of this exposure and continuing to grow in a way that is safe, secure, and very efficient.
Wendy, you've given us some really specific examples, and I was just noting down some of the themes: managing the supply chain in Asia, managing the FX exposure, particularly down in Mexico, getting a presence to the United States, working that out too. Wendy, what I hear here is the need to be with a bigger player. And that's what we saw coming out of the regional banking crisis as well. Customers were looking to the Bank of Americas of this world. Wendy, is that still the same now? Have you held on to those clients? Are you seeing more clients come towards you ahead of 25?
We are. And in fact, 2024 has been a great year for us. It's our second strongest year in terms of client acquisition on record. And we expect that to continue into 2025. And it's for all the reasons you've just cited. You know, our client base is more global now than ever, and they absolutely need a partner who can help them navigate a lot of this uncertainty and turn that into opportunity for them.
BofA President of Global Commercial Banking, Wendy Stewart, speaking with our colleagues Lisa Abramowitz and Jonathan Ferro. And these are some of the other corporate stories that we're following at the moment. Bloomberg has learned that SpaceX is in discussions to sell insider shares that could boost its value to around $350 billion. That would be a significant premium to the $255 billion valuation reported last week. It would also cement the status of Elon Musk's rocket and satellite company as the most valuable private U.S. firm. A Delaware judge has once again rejected Elon Musk's record-setting Tesla pay package, even after shareholders supported reinstating it. Kathleen McCormick decided to stick with her original finding that the company's board was too much under Musk's influence. The stock options package was worth $56 billion by the time McCormick canceled it, and more than $100 billion at Monday's closing price. The Biden administration is offering $7.5 billion to finance a battery hub in Indiana. The conditional loan for a joint venture between Samsung SDI and Stellantis is expected to fund one or two lithium-ion plants in the city of Kokomo. The funding could be canceled by the incoming Trump administration if not finalized by Inauguration Day. U.S. agriculture giant Cargill is cutting thousands of jobs globally after missing profit targets. An internal memo says the largest privately held U.S. company will cut about 5% of its 164,000 staff. Cargill has seen earnings shrink on lower corn and soybean prices, while the U.S. cattle herd was the smallest in 7 decades.
Sherry, let's take a look at how we're faring when it comes to Asian markets. And broadly, we are seeing markets tracking Wall Street higher there as we see traders really awaiting some of the key payrolls data, going through some of the Fed speak that we've had from the likes of Christopher Waller as well, saying the favouring of a December for the next move. We're seeing the US dollar snapping that 3-day losing streak, with the euro coming under pressure, with the fiscal situation, the political sort of divisions really putting France on the brink there. So we're watching that very closely, but we are seeing broad upside when it comes to trading across Asian equities at the moment. We're also watching, of course, as I mentioned, not just the payrolls data, but what comes next when it comes to oil prices. They're trading pretty much range-bound at the moment as we look to that OPEC Plus meeting. We are expecting OPEC Plus members to really kind of stay quite steady with that supply meeting, with the expectations of a glut next year, set to kind of see that delay in the restoration of production as well. So when it comes to crude prices, we expect to see that in a narrow range. We do have some data just coming through as well when it comes to Australian trade numbers. Of course, any trade data is really key given the precariousness of trade across the region, as well as Australia kind of trading as a bit of a China proxy if we do see the full force of Trump's trade tariffs coming into effect next year. That third quarter current account deficit coming through there as well when it comes to net exports, adding just a tenth of a point there to GDP. Much more ahead on the Asia trade. This is Bloomberg. Well, clearance has been given for Australia's first ever commercial space launch. Gilmour Space Technologies is expected to make its first test flight within a few weeks and already has Australian customers signed up waiting to get satellites into orbit. Bloomberg's Paul Allen has more.
History will soon be made in this field in North Queensland. Gilmour Space's 25-metre tall, 30-tonne rocket is cleared for launch by Australia's space agency.
It's really, really hard to come up with an orbital rocket, and I'm happy that we've gotten to the point we have, and I really hope that the first launch goes reasonably well. I'm not expected to go to orbit. Historically, they never have, but we're going to learn a lot.
It's been a long time coming. Gilmour Space started its rocket program in 2015 and was initially expected to launch in 2023. Getting regulatory clearance has taken longer than expected.
You can imagine when you go to a regulator and say, hey, guess what? I want to launch an orbital rocket from Australia, the kind of first reaction. So we've spent a lot of time educating a lot of different people.
Customers are already lining up. First in the launch queue is Space Machines, an Australian satellite company that offers roadside assistance in space. Once in orbit, its mini modules wait, deploying when needed to carry out repairs to other satellites. For Space Machines, having a local launch option will be a game changer.
I think it gets rid of a lot of different costs. Having a launch capability in Australia will mean we won't have to travel much, we don't have to think about spacecraft getting damaged, having capability to very quickly turn it around for subsequent launches. So I think it gives you a number of advantages of having it onshore.
The significance of pushing through all the technological and regulatory barriers to get the rocket to the launch pad also can't be understated.
Adam's done an amazing job of persevering through all of that. There's a sort of almost a colloquial thing where US produces unicorns, I think Australians produce cockroaches. We need to survive. And in the process of survival is success.
In terms of survival, while the test launch for Gilmour Space is an important milestone, harder challenges are yet to come. A regular, reliable launch schedule and ultimately turning a profit.
In the last couple of years, we've just had continual customer demands for us to launch. And so, the customer equation's there, and they're as strong as it's ever been. So I think they understand once we get the technology right, our path to profitability is very quick.
As for liftoff, an exact date hasn't been settled, but space geeks keen to watch the show might consider a Queensland beach holiday for early 2025. Paul Allen, Bloomberg, Sydney.
And Paul is here with me as we talk a little bit more about the outlook for Australia's space sector. Let's bring in Cassandra Steer, who's a chair at the Australian Centre for Space Governance. Cassandra, great to have you with us, and obviously very exciting to be able to get finally this approval. How meaningful is this, do you think, when it comes to the broader space industry and the ability for more commercialisation or perhaps quicker progress?
Yeah, well, first of all, thanks for having me. And it is exciting. We do have 2 existing spaceports, but they operate kind of like an airport. They're there for others to bring their rockets. We've had NASA launch very small sounding rockets from the Northern Territory by Equatorial Launch Australia. And there's another site in South Australia that's run by Southern Launch. But the fact that Gilmour has its own rocket, because I think perhaps it's not clear to a lot of people that the rocket is one thing, it's the launch vehicle, but there are other companies like Space Machines that are building satellites that just need to get them into space. So having an Australian rocket that's able to launch from Australian soil is quite exciting. But I think we also need to temper what this means in terms of this is not going to open floodgates of launch capabilities. I mean, there was a story earlier about the size of SpaceX, the biggest company in the US. It's the biggest commercial launch provider in the world. And Americans and a lot of other clients around the world go with a proven reusable rocket that's a lot cheaper. We certainly will see opportunities for Australian-made and locally made and regionally made satellites being launched from here, but we have to temper expectations about how big that market is.
Where do you then find the more niche opportunities then? Because as you point out, there's not a real competitor to SpaceX yet. There is also in our part of the world Rocket Labs just over in New Zealand as well. So for Australia, what's the path forward to be able to not have more commercialisation, but perhaps more opportunities that are not yet as well tapped?
I think the biggest opportunity for Australia is the launch and return end of things. So in the next couple of decades, we're going to see point-to-point suborbital travel become possible. So they still need to be rockets. They don't need to get to orbit. They go into space and they come back down. And that means we could get cargo and maybe aid packets and eventually people from Australia to Europe or North America or the Pacific in a matter of a couple of hours. So I think that's going to be the groundbreaking thing in the future. And we really need to look out for the opportunities for return and relaunch in Australia. But the other thing is that space is overwhelmingly commercialised. You and I have used space at least 20 times today already by checking the weather, using navigation. If you get an Uber somewhere or order food or order delivery of items online, when you buy a coffee with your phone, we're using space services every single day. And there's about 10,000 operational satellites today. 75% of those are commercially owned. So militaries are buying commercial space services, governments are buying them, and you and I are using them. So that market is not going to go away, and there are definitely opportunities in that sense.
When I was speaking to both Adam Gilmour and Space Machines for that story that we just saw, they were both very diplomatic about the role of regulators, but you could sense the frustration and the slowness in getting this done. As the industry matures, do you see the regulatory process getting a little bit easier, and to what point is it a hindrance at the moment?
Launch is a very specific technology, so there's different permits required. If you are a satellite operator like Space Machines, you need to go through a different set of permits and regulations than if you are operating a spaceport like Southern Space and ELA are, and then a different set again if you want to launch your own rocket from a spaceport, from a space site. So I can understand that for Gilmour it's been frustrating. They've had to reassure investors and it's taken a while, but the Australian government absolutely did the right thing by taking its time. This is the first time the Space Agency's given this particular launch permit. We need to think about things can go wrong. You know, as Adam Gilmour himself said, it's a test the first time. There's issues around rocket fuel. Everything that goes up must come down. There will be small amounts of rocket body, possibly bits of debris. There's bits of propellant that might remain in the atmosphere. Gilmour Space is quite close to the Great Barrier Reef. We need to think about environmental impact. We need to think about the impact of the noise of the launch on local wildlife. So they needed to go through a series of very important regulatory checks, insurance checks, those kinds of things. So they absolutely did the right thing by taking their time. And other kinds of permits are much faster, particularly for satellite operators, because we have more of those in Australia than we do a rocket launch company.
Yeah, the Gilmour rocket at the moment is not reusable, well, yet. In the 21st century, can a rocket launch company be competitive with an expendable rocket?
That's the question. I mean, SpaceX has really changed the game by creating reusable rockets. That has environmental benefits, obviously, because every other rocket in the world to date is single use. That's the equivalent of building an airplane, using it once, and then throwing it away. So making them reusable, SpaceX has done a really incredible thing technologically. It's also reduced the price of being able to hitch a ride on that as a satellite operator and get your satellite into space. So it is hard to be competitive with that. At the same time, if you have to get your satellite, which you've built in Australia or you've built with components in the region here, and you have to ship it to the US, there are enormous shipping costs, insurance costs, and risks that your very delicate piece of hardware might get damaged along the way. So there are different avenues that could be competitive for different reasons. I don't think Gilmore's rocket design is set up to be reusable in the foreseeable future. I think that's where all rockets eventually will have to go. But this is all, it took quite a while for the aviation industry to become what it is today. It's going to take a while for these launch vehicles and suborbital vehicles to become reusable.
Cassandra Steer, who's from the Australian Centre for Space Governance. She's the chair there. Really great to have you with us. We have more on Australia Ahead every Tuesday at 11:40 a.m. if you're watching in Sydney. That's 8:40 a.m. if you're joining us in Hong Kong. Plus, you can tune into the Bloomberg Australia podcast, delving into the biggest stories shaping the country's role in global business. You can find that on Apple, Spotify or Bloomberg.com. More ahead on the Asia Trade. This is Bloomberg. Well, the annual Bloomberg NEF Summit begins today in Shanghai, bringing together executives, decision makers and industry experts in the energy transition. Among those at the two-day summit is Andrew Forrest. He's, of course, the founder and executive chairman of Fortescue, one of the largest iron ore miners. And he joins us now from our Shanghai studio. Andrew, always great to chat with you, of course. And, I guess I wanted to start off by asking how optimistic you are when it comes to the energy transition, given that we've just come off, in a lot of ways, a very contentious and disappointing COP29. That transition to wean off fossil fuels has been pushed back for another year, and also disappointment when it comes to the plastics conversation in South Korea as well. What's your mood right now?
Look, the plastics conversation, the failure of that summit was utterly predictable. The fossil fuel sector sent 300% more lobbyists than there were countries represented. You have what's called a consensus, but it actually means everyone has to agree. So one plastic producing country can just stop progress for the entire world. So it's clearly a system which isn't going to work. That's now proven after a 5-year lesson. We have to go about it another way. Plastic is harming human health. It's harming the whole ecology of our planet. It must stop. These people really need to get their head across it. But as to the energy transition, Heidi and Sherry, yeah, look, there's issues on the horizon, but am I optimistic? Am I close to the breaking technologies which are coming down the barrel at us now? Yes. Fortescue's, yes, I am. I can see the changes coming. And basically, if North America wants to slide back into oil and gas, coal, good luck to it. Its citizens, its companies, its investors will put up with this gyrating energy cost. They will put up with the fact that their cost of living from energy will be dictated by despots, dictators, oligarchs, who they will never know. When you've actually got this massive social transition happening in the rest of the world, where the power is coming out of these huge companies and players into the hands of the people, into households, into companies, even countries. And that's this massive social transition, which the fossil fuel industry can see its grip sliding down the pole, and it just has to happen. Economically, look, am I really excited that we've got technology that can charge our trucks at 6,000 kilowatts in half an hour, that can charge cars in 30 seconds? Am I excited that we're bringing down the cost of making hydrogen massively? Yes, I am. And I'm just seeing this massive transition in history happening. And if those countries who follow renewable energy will grow stronger, take China, and those who don't will slide back, take North America.
You just mentioned North America, so let's talk a little bit about President-elect Donald Trump. I know that his transition team has already approached your team. Have you had direct conversations? And how will you try to change his mind when it comes to really fossil fuel and the reliance on oil?
Look, President-elect is an economic pragmatist, and he's also won an election in large measure on creating fear about the wind back on renewable energy, creating fear about China. You put these two things together, there's one country being enormously economically pragmatic, Sherry, and that is China. It will account for 50 to 60% of all the solar energy both produced and installed in its own country before the end of the decade. It will have this rising and steady growth in standard of living of its citizens. Those who pull back on it, who've created fear by saying, hey, look, cost of living might go up. Now, there's a war in Ukraine, there's a war in the Middle East. Let's not change now. It's a bit risky. Well, actually, that is the time to change. And of course, North America has this wonderful opportunity to go surging ahead for its citizens. But if it tracks back to oil and gas, Sherry, it's just going to see this economic transition happen. You've had the Chinese economy once easily the biggest in the world centuries ago, and it'll just go back there quicker now.
Andrew, I wanted to quickly ask, and obviously you've talked about some of the opportunities for China. What are the opportunities for Australia in this new era?
I think if we too stop dilly-dallying with politics, we talk about nuclear, we kind of forget that no one wants to buy it, so it's going to be copped by the taxpayer. We talk about going to solar and wind, but then we're really slow on getting the transmission lines in. Why? Because we nickeled and dimed. We cut corners on transmission reimbursement for the people who have the transmission lines going across the land. We should have just faced straight into that, Hardy, and we didn't. Now, as a result, it's slow, but is the technology increasing? Is the market impatience with very high cost of living driven by coal prices, oil prices, gas prices, getting more and more impatient? It is. Renewable energy is Australia's future. It's just how quickly can we grasp it before the opportunity is taken by others.
Andrew, it's always so great to chat with you. Andrew Twiggy Forrest there, founder and executive chairman of Fortescue. That is it for the Asia Trade. Our markets coverage continues. The China Show is next.